Dan, talk to me about a little bit about the ripple effects of the Silicon Valley Bank collapse on the index business and on ETF markets. Well, you watch this every day. What impact is this having?
Yeah, I mean, great to be here. Thank you very much. Look, in terms of the good news is markets are working. We're seeing price discovery. We're seeing, even though it is higher volatility, we're seeing risk, again, being priced efficiently, so going through the markets. So the indices are working well, particularly in equities, but we are having some impact. You're seeing Silicon Valley Bank, we announced, has left or will be leaving on the open on Wednesday of the S&P 500 index. Also announced this morning, Signature Bank will also, pending a time after the close, will be leaving the index as well.
Yeah, and John, what I had saw last week was really remarkable, the moves in the ETFs. The Spider Bank ETF, the KBE, it's down 25% in the last 3 days. I mean, these are big banks. That's rather stunning. And this is an equal-weighted index. It's targeted to the S&P Bank Index, right? I saw volumes on Friday. I don't think it was an all-time record. This has been around about 18 years, but it was close to an historic record. Maybe some stuff in 2008, 2009. What, if any, trading stresses emerged from this wild week? What I saw was a lot of price drops, but the plumbing intact. But what's your point of view?
Yeah, I think what's important is that, despite all the volatility, stocks get halted, the ETF continues to trade, volumes go up. People look at the ETF as a price discovery tool, so they're not sure where the next regional bank stock that's halted is going to open. But people look to the ETF market to say, okay, what does the market expect the sector to do? And I think the plumbing actually, time and time again, always prevails, and we find out the ETF is the go-to place to get liquidity and to see what the market expects for the sector.
The important thing we have to keep, and this is an educational moment about the ETF business, a lot of the underlying stock never trades when you're trading, for example, the KBE. You simply trade the stock itself, and while you might have the underlying trade if you're having redemptions and creations, for the most part, that's an enormous amount of liquidity that happens trading banks, the KBE, without actually trading the underlying stocks. And that provides some kind of relief to the overall market worried about trading those individual stocks.
Absolutely. Yeah, so the ETF is a go-to vehicle. There's so much liquidity in the secondary market that there's not even a need to kind of do a creation redemption. So that's a good thing about ETFs.
We also had huge inflows into sort of short-term cash instruments. Like I've been putting up the iShares short treasury bond ETF, the SHV that's out there, Spider 1 to 3 month T-bill. Very attractive for investors who are worried about everything from rising interest rates to further market volatility. Those are yields on those are reversing a little bit in the last few days. But again, volume is titanic, and for everyone who says, "Oh, you're never going to be able to price these on moments of volatility because the underlying bonds will freeze up," well, it hasn't happened yet. It's not. Nobody's trying to say it's not been a mess, but the plumbing works.
Yeah. Yeah, I think the naysayers need to pick a different topic because we've seen time and time again fixed income ETFs liquidity goes up even though there's underlying volatility in the bond market. So
yeah.
Okay, maybe you should just pivot back. The larger liquidity story, I think, is really strong. ETFs are part of, and a big driver, but a bigger liquidity story. Think about exchange-traded derivatives, futures, options. The SPX options had a record trading day on Friday. People are trying to price risk. They're trying to find portfolio insurance in many ways.